Today, I'm nominating Jerome Powell for a second term as chair of the Federal Reserve.
The economy is strong overall and has made significant progress toward our goals over the past 2 years. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes.
Can you imagine how the change in Fed rate is affecting Indian economy and the Indian stock market? Not just that, but also the global economy as well. Curious about what Fed rate is? Who decides this Fed rate? How often it changes? And why is this important? And how is this affecting India and Indians? Let's figure out the answers for all these questions. But first, let's start with what is Fed rate. Fed rate, which is the short of Federal Funds Rate. It is the rate at which the US banks lend each other money overnight. Think of it as the control norm for US economy. US government regulating the flow of money to keep inflation and growth of money on track. This Federal Reserve is located in Washington DC, but its decision impact the whole world economy. But who decides the Fed rate? The Federal Open Market Committee (FOMC) decides the Fed rate. It is the part of Federal Reserve. The committee comprises policymakers who meet to analyze the economic conditions, including inflation, flow of money in the market, employment, and growth. On these factors, the decisions are made. But how often are changes seen in the Fed rate? So basically, the FOMC meets 8 times a year, that is every 6 weeks. And when they meet there, they analyze all the data, the economic conditions and everything in front of them, and keeping those things in mind, they decide whether to increase the Fed rate or decrease it. However, in the time of economic crisis, emergency meetings are held up by FOMC. But why is Fed rate so important? Because the Fed rate controls the cost of borrowing and lending money in the US economy, influencing everything, including home loans to business investments, which helps controlling inflation, growth in the economy, and to maintain financial stability. Before moving forward, let me explain you with an example that what Fed rate is and how it impacts the economy. So as we are talking about this very important topic, Fed rate, it is very important to understand the basics of Fed rate. So I'm going to explain you how this entire Fed rate works and how it impacts the Indian economy and the Indians. So let me give you a very live example for that. So as we can see here, you can consider the Federal Reserve, from where the decisions for the Fed rate is considered as a water tank filled with water. Now, the pipelines connected to it are banks through which people and businesses take the loans. So these pipelines are the banks which are connected to the Federal Reserve. Now, the flow of water is basically controlled by the faucet. Now, here comes the important part. This faucet is the Fed rate, which controls the flow of water here. So the Federal Reserve basically flows money through banks to the people and the businesses. But this faucet plays a very important role. If the faucet is tight, that means the water flow is gonna get reduced. So basically, if the Fed rate is higher, the interest rate is higher, the flow of money would be reduced, resulting in higher borrowing rates for people and businesses, resulting in less expenditure and reduced inflation. But if this faucet is loosened, then the flow of the money would be increased, resulting in higher borrowing and increased expenditure, which will result in the boost in the economy and creating more jobs and more cash flow in the market. So I hope you understood what Fed rate is with that example, but moving further, let us come to a very major point, that how is Fed rate impacting India's economy and its stock market. Starting with the impact of Fed rate in Indian stock market. So when the interest rates in US increases due to higher Fed rate, the foreign investors pull their money from Indian stock market and want to invest in the US dollars, because that is gonna be more profitable and beneficial for those investors. So when they pull the money from Indian market and invest in the foreign market, it leads to outflow of money from Indian stock market, resulting in fall of stock prices in India, affecting the mutual funds and investment portfolios. The second impact is weakening of the Indian currency rupee. So when the investors pull out their money from Indian market, they sell rupee to buy dollars, which increases the demand for dollars and decreases the demand for rupee. And when the demand of the rupee decreases, automatically it weakens the Indian currency. Basically, in India, lower dollar inflow and higher dollar demand depreciate the rupee. Third impact, the impact on inflation and RBI. When the foreign investments in Indian stock market or Indian economy is less, we come to a shortage of capital. To neutralize that, the RBI itself increases the interest rates in India to control the inflation and stabilize rupee, resulting in higher borrowing interests for both people and businesses, which also results in increased price of goods and services. The fourth impact, higher import charges. When the rupee weakens, India needs more money to buy dollars for imports, which increases the trade deficit. A higher trade deficit puts additional pressure on the rupee, which weakens it further. Like for example, India imports crude oil in US dollars and India imports more than it exports. Number 5, the daily impact. So because the interest rates are increased by the RBI for Indian economy, everything becomes costlier, from fuel, food, services to EMIs and business loans, leading to a costly impact on the daily lives of people and businesses. Now, how does the Fed rate affect Indians? So, starting with the homemakers. Rising inflation means all the daily requirements like groceries, fuel, petrol are costlier, leading to higher spending. When talking about traveling to different countries becomes even costlier because the value of Indian currency decreases, the rupee, and when you travel outside of India, you have to pay more. When talking about students, the study abroad costs increases. Talking about loans, the interest rates on loans significantly increases, due to which taking car loans, home loans or personal loans, and you have to pay more interest rates than usual. When talking about the investors and their investment, market impacts mutual fund returns and stock portfolio. So this we understood about if the Fed rate is higher, what are the impacts India and Indians gonna face. But there's a different possibility as well. What if the Fed rate decreases? What will happen then? Let me explain. When the Fed rate decreases, there comes the low interests, which makes the investors less interested to invest in US dollars, which results in flow of foreign money in Indian market, leading to boosting stock market and strengthening the rupee. Less investment in dollars can weaken the dollar relative to other currencies like Indian rupee. With low Fed rates, that means lower interest rates, Indian companies and banks find it cheaper to borrow money from international banks and market. Low Fed rate stimulate the global growth by benefiting the Indian exporters. A stronger rupee means India has to spend less on US dollars for its imports, like crude oil, machinery and electronics. Lower Fed rates often push foreign investors to invest their money in Indian markets for higher returns. The Fed rate has a significant impact on Indian and world economy due to its interconnectedness. The Fed rate acts as a global lever that impacts India through currency, inflation, investments and borrowing costs. A higher Fed rate often creates challenges for India, but a lower Fed rate can bring opportunities as well. And understanding this Fed rate can help you take good financial decisions. And if you are an investor in stock markets, you will get an idea about how to invest, when to invest, and when to stop. I hope you understood everything about Fed rate. So the next time you see a change in Indian currency, you might know the reason behind. There's a possibility it's the Fed rate behind. So if you like this video, don't forget to subscribe to Freedom English and let us know in the comment section your opinion about the Fed rates.